All right, breaking news, Fannie and Freddie revising the scoring models being used in mortgages. What does that mean for you as a consumer? Are you going to qualify for more? Are you going to qualify for less? Will your score go up? Will your score go down? All that and more. Stay tuned. All right, Matt, the mortgage guy, residential mortgage broker, licensed across the country. Happy to help you. If you want to connect with me and my team, go to greatmortgagebroker.com, fill out the quick form, let us know where you're at, how we can help. We'll be in touch shortly. If you're looking to connect with a great realtor anywhere across the country, go to homeandmoney.com/Matt. Before I jump into it, one quick joke in honor of it being the week of Halloween. What happened when the man couldn't afford the mortgage on his haunted house? It was repossessed. All right, for more dad jokes and all that, subscribe, like, do all the things. In today's video, I want to talk to you about Fannie Mae and Freddie Mac, and I'll pull up the article, which was one of many that came out today, talking about the new scoring models, what they mean, and what it might mean for you specifically, right? Because there's differences in these scoring models that may either help or hurt you depending on how you use credit. I'll give you some advice towards the end of the video on what you can do to make sure that in these new scoring models, your score is as high as possible. So first, let's just share one of these articles. The federal government is expanding how it collects credit scores, which may allow more Americans potentially buy homes. They say this because this model that's being rolled out isn't necessarily new. I think FICO 10T was really put out there early 2020. It hasn't been implemented and used in mortgage or in other industries by at any scale, but it's already there, and it's different in how it assesses credit and someone's credit worthiness, and so it's going to help certain people that are responsible with credit. And I'll tell you more about like what that T stands for and what that's really doing. So the announcement, the Federal Housing Finance Agency Monday announced that it had approved two credit score models, the FICO 10T and the VantageScore 4.0 for use by Fannie Mae and Freddie Mac. Now, the funny thing is they announce that they've approved these two scores for use by Fannie Mae and Freddie Mac. Doesn't mean that Fannie Mae and Freddie Mac are going to use them. Right now, Fannie and Freddie are using TransUnion, Experian, and Equifax, and those are pulling data based on like FICO 4 and 5, I believe. So just because these are available doesn't necessarily mean they're going to use it. But Sandra Thompson, director of the FHFA, said, it's time to recognize the significant innovations that have occurred in credit score modeling. I agree with that 1,000%, right? And I don't know if it's this article or another one, but there's certain things that you probably heard of in these last couple of years where you start to incorporate, on-time rents and things like that into these scoring models to help more people qualify. I think it was this one. Here towards the bottom of this article, 16% more Hispanic and African-American households would have expanded mortgage access, meaning they're going to get a yes answer more often based on these algorithms and these models that take into account more things, right? Like just more accurate data is going to allow more people the chance for mortgage access, which is a good thing, right? Wu, who's an executive over there, said, this particular decision is good. This credit score model should have been updated a long time ago. And really, like, these talks have been going on for years and years. This references like a 2015 study saying that 72,000 more households would have access. So a quick what you need to know. FICO 10 Suite is the newest of the FICO scoring model, and it consists of the FICO 10 score and the FICO 10T. And here's where I'll explain what that T means, because I think this is really interesting and something that people should know. Here, it just says the FICO 10T credit score includes trended data, which looks at an individual's payment and debt history for the previous 24 months to help calculate credit scores. Let me break that down to you in layman's terms. they're not just looking at the fact that you have an $80 balance on a $1,000 Home Depot card and a $3,200 balance on your $5,000 Wells Fargo card. They are looking at what kind of balance you've held over the last 2 years, 24 months, and how that has trended. Because, I've listened to some really smart credit guys talk, and some of us that know, or some of us that try to quote unquote game the system, might take somebody with $9,000 in credit card debt over, cards with limits of 12,000 or 15,000. And we know that if you pay that 9,000 down to 2,000 and you've got 15,000 in usable, access to credit, but you're only using 2, that's going to look really good. That's going to boost that person's score by 70 or 80 points. This is where I think this model could actually hurt some people, right? That person in that particular scenario wouldn't be able to game the system because they'd pay it down to 2,000, and the model would go back and look and say, hey, listen, over time, your debt utilization, how much you use versus how much you have available, is always high. 19 months ago, you had 8,000 in like credit card, availability, and you were using 6,600 of it. You pay a little off, you charge a little more. You pay a little off, you charge a little more. And then when you got another card, which upped what you had access to from 8,000 to 12,000, your balance ran up to 9 and then 9,500. So based on that historic data, you tend to just get yourself into more debt as you got access to more debt, right? That's a different picture than somebody pulling the credit and looking at it and go, wow, they've got 15,000 available credit. They only owe 2,000, not knowing they paid off 7,500 of that 48 hours ago, right? That's part of the system that can be gamed currently that won't be able to be gamed with this quote unquote trended. That's what that T stands for, is trended over the last 24 months. So according to FICO, this new model is the most comprehensive scoring model created. They don't replace other scoring models, FICO 2, 4, 5, 8, or 9, which lenders can still use in making credit approval decisions. And that's the key thing to know as a mortgage lender or as a consumer looking to get a mortgage, is that just because this is out there doesn't mean that they're going to use it. Now, I feel like in these articles, when it says like revises credit score models, Fannie and Freddie, changing the credit score models they'll use, maybe they do go to these models. If they do, I think there's enough positive in there that's going to help people qualify, where I wouldn't classify it as a negative thing just because I told you, it's trended and it looks at 2 years. It's not going to allow you to game it, right? There's still going to be plenty of benefit with this new one because like it says here, it will expand access to credit for borrowers with less robust credit histories. It's actually taking into account such things as rent, utilities, telecom payments when available, right? So both of these two new models account for that stuff, which is going to help more people qualify. So it's ultimately a good thing. And so just to wrap this up, so people that are like, what the heck is he even talking about? Like Experian, Equifax, TransUnion, all these agencies that you've heard of, it's not that they give you, a credit score, and one of them's got 715, one's got 735, and one's got 719. They're using scoring models, whether that's FICO 2, FICO 4, FICO 5, this new one, FICO 10, FICO 10T. And so the models becoming available is what's changing. Whether or not Fannie and Freddie are going to use those is yet to be seen. What they're hinting at here is that they are going to use these. It's going to allow expanded opportunity for home ownership. This trended data and whatnot is really a better representation of how somebody handles credit. Lastly, I won't get into it in this video, but it was part of the same article, so I can't just skim past it. Fannie Mae and Freddie Mac, also said Monday, through the Federal Housing Finance Agency, which oversees these guys, eliminating upfront fees for several categories of borrowers and affordable mortgage products, while they increase upfront fees on cash out refinances. So, increase fees on cash out refinance, lower fees for, it says more here, and I'll paraphrase it for you, low to moderate income borrowers, folks that need it the most, underserved communities, all those things. We've heard this. We know this is coming. Less than 100% AMI, less than 120% AMI borrowers who are in general, the hardest hit or have the least access to mortgage are going to see more and more of this type of stuff implemented, where we're going to offer loans to you cheaper, better, faster, and really cheaper is what FHFA is saying. There's going to be less fees associated with this to allow access to more people looking for loans. So any questions, comments, concerns, leave your comments below, subscribe, like. I'm just a mortgage dude out there trying to share mortgage information to whoever might benefit from it. If there's something you want to see that I haven't done, feel free to leave me comments on that. I just trying to spread some information, empower people through edumacation. So till next time, we gonna see. And again, if you want to connect with me and my team, greatmortgagebroker.com. See you soon. Bye-bye.